Joe, why don't you tell me a little bit about your background?
Look, I started in chartered accounting for a few years, and then I moved into financial services, primarily on the distribution area. 15 years or so ago, even maybe a little bit longer, I moved specifically into property funds management. I learned a lot about syndication and non-bank lending, etc. 2012, 2013, you and I came together and we started Capital Property Funds. Why don't you tell me a bit about yourself?
Yeah, thanks, Joe. My background's it's always been real estate. I started originally as a property valuer, moved into real estate consulting and advisory with a local real estate agency based in Sydney, and then moved into investment banking, real estate. So I worked for 3 investment banks and ended up running real estate at Merrill Lynch for a number of years. Went out and then started a separate real estate advisory company. Worked on that for 4 or 5 years, and then you and I came together and we started Capital Property Funds, originally doing property syndicates, and we've expanded that business into doing specific mandates for investment management, as well as recently starting the property debt fund.
And look, why don't we talk about, all those years ago, that first asset we did at Parramatta?
Well, they always say the first one's the hardest one.
Yeah, that is true.
The first one was the hardest one.
Yes.
I mean, as you know, Joe, look, we raise all the equity for our funds from our own investor base.
Yeah, that's true.
We don't have a third-party group soliciting equity for us. It's all been in-house. It was tough. I think investors said, we trust you, know you, but come back when you've done your first fund. So it was hard to get up. And the second one, the 601 Coronation Drive, I mean, it wasn't a walk in the park, so to speak, but it was a little bit easier because we'd already done a fund.
It was a big asset. It was a $30 million asset, which at the time was quite a big asset for us. But it was a very good location. I think the timing was right. I think Parramatta was just emerging as the second CBD. We acquired it off a vendor who had done a substantial amount of repositioning, and it turned out to be an excellent result for our investors. You and Julia worked on the asset, but it was yielding an 8% return, so that was paid quarterly. We acquired it, as I said, for $30 million, and then we can talk about, actually should talk about some of the work you did on repositioning that asset. But at the end result was it was sold for, I think, after a 3-year period, around about $56 or $57 million. I can't remember, but I know that the investors more than doubled their initial equity.
That's right.
Fund.
That's right. I mean, it was a stabilised yield product, which is the type of syndicate that we've done in the past. In this instance, it generated significant capital return over a 3-year period. So the investors did double their money over 3 years. But it was really predicated on a leasing strategy on that building. We bought it at 20% vacancy. So we had to lease and we had to put capital into it. We converted 15 car parks into office space. So we created some value along the way. But to your point earlier, Joe, the market started to discover Parramatta as a valid office market through that term. And we got a significant cap rate compression. We bought it on a initial yield of 8% and sold it on a cap rate of under 6.
It's quite
so
incredible.
there was a big shift in market sentiment towards office assets in Parramatta.
The next asset after that was a $45 million asset. It was an A-grade asset, and we still own that asset. A beautiful tenant amenity, natural light, abundant natural light. Beautiful views of the river and the city, access to transport amenity and retail amenity. But we did acquire that asset with another 20% vacancy, didn't we? So that was yielding again 8%, and that's net of all fees and expenses. Where are we now with that asset?
Yeah, well, again, it was a similar story to our Parramatta asset. The 20% vacancy, it needed some work. It needed a strategy around leasing. So what we decided to do on that asset was to carve up or split up some of the floors into smaller suites. And spend capital by installing spec suites. So they're already fitted out suites that then become very attractive to tenants. They can just simply move in straight away. It did take a while to get the spec suites built, but once they were built, it's led to that building now is 100% occupied.
And we have learned a lot too, haven't we, about the Brisbane market? I mean, we learned what that market needed, and once you realise that, then we've got a model that works.
I mean, there are some things like 601 Coronation Drive didn't have, which was an end-of-trip facility. We lost 4 or 5 car parks, but the amenity that the The tenants now have is a brand new high quality end of trip facility and bike storage and cage facility. So it's something that if you don't have it, some tenants won't come to your building unless you have an end of trip facility. So we've done that. We are going through a process now to reskin the whole building and remove ACP panels. At the time when we acquired the property, they weren't an issue. They are an issue now for fire safety. So we've just awarded a contract now to replace the entire panels of the building, and that'll work will commence shortly and finish by the end of the year.
On that too, the investor experience over that 5-year term of the fund, I mean, they've had an 8% return, net of all fees and expenses, good capital stability, because there was a bit of volatility around, particularly in the stock market around COVID, which it was very capital stable, and they've even had a little bit of capital growth, and hopefully they can continue to enjoy that. Let's continue on with the theme of Brisbane. I mean, we've sort of become experts, I suppose, in taking on leasing risk and solving that problem, but probably we've become experts in the Brisbane market. Out of our business all those years ago, we've had some high net worth investors or semi-institutional investors have come to us and given us some mandates. We've acquired a few assets in the Brisbane CBD. The strategy there has been to buy an asset for say $30 million or a little bit more than that, and then improve the tenancy profile by adding new suites and putting better tenants in.
It's a mandate asset on behalf of our client. We acquired that asset from 3.5 years ago. It was about a 30% vacancy. In a normal cycle of owning a property, you'll get tenants coming in and out of a building, but that building had been a little bit unloved, and what we've done to date is we've put quite a bit of capital into the building services. So we've replaced all the air conditioning plant, the chillers and the building's electrics, and installed a number of spec suites across 3 or 4 floors of the property. All those spec suites have all been leased, and we've just completed 2 more spec suites. So we're rolling out the spec suite strategy throughout the building, and it's been successful. I mean, it's something that will carry on. The vacancy has come down a bit, but there's a way to go, but it's not an overnight fix. It's a strategy that takes 3 to 5 years to work through.
And that'll result in enhanced quality of income to the investor and quite likely a good potential capital growth.
Appreciation. Yeah. Absolutely. Again, that was an asset that was acquired on a yield of fully leased yield of 8%.
It's quite incredible, isn't it? Yeah.
So, the cap rates on comparable assets now are significantly less than that. So we do expect significant capital appreciation going forward.
We're not Brisbane centric, but we do like Brisbane. They've just been awarded the Olympic Games. They've got a 10-year head start on that. So we see a lot of capital works being spent within the environs of the Brisbane CBD. All the engineers and workers that they're going to have to be implementing all that capital works need to be accommodated, and that's probably going to be within the CBD environment. So we believe that there's going to be an uplift in demand for office space in Brisbane.
Through COVID, I'd have to say leasing was brutal, is probably the right word.
Yeah.
It was very tough, but we're coming through now and we're seeing a lot of green shoots. Tenants, small companies are coming out of co-working type space, want their own accommodation, and they're growing and expanding. So we are seeing now a lot more demand over the last 6 months than we saw towards the tail end of COVID. It's got a way to go, but I think what we're seeing is a weight of capital chasing Brisbane. We're seeing a value proposition compared with, say, Sydney and Melbourne on a rate per square metre or a cap rate measure. And Brisbane's seen as a bit more of a value play. So there is a lot of capital chasing the type of assets that we're looking at.
And look, lastly, I'll probably touch on the debt fund. We've been lending into the southeast Queensland market on first mortgage loans. Luckily, to developers that have been known to us for a long period of time. So high quality integrated developers that are competent and know what they're doing. We've been sort of providing yields to our investors net of all fees and expenses around about 8%. Sometimes a little bit lower than that, sometimes a little bit more than that, but around that mark. Whether that sustains will be interesting to see with where official cash rates move. But for investors looking to invest with us, we've either got private mandates if they want to put a larger amount of money with us, or if they want to put a small amount of money into one of our funds, which are typically a little bit more longer term, that 2 to 3 year period, or if they've got a shorter dated time frame, they can come into our debt fund. You won't get the capital growth, but you're getting the security of a first mortgage investment and a fairly good rate of return. All of our funds are paid quarterly, and you and I invest in every single fund that we do.
Well, that's important. It's what we call, we've got skin in the game on every single deal. We're putting money in, like we believe in what we're investing in.
That's true. If we can't put our own money in, then how can we ask the investors to
That's
do
right.
it? All right, Andrew, thanks again. Thanks for the chat.
Yeah, thanks, Joe.